In this video, I'm going to explain to you exactly how you can use fair value gaps to your advantage in trading, how you can use them to gain entry confirmations in the market. So without further ado, let's get into this no bullshit guide on how to trade FVGs. Okay, so fair value gaps are extremely fucking simple, okay? Let me back out of this. Okay, right, we're not in replay anymore. Fair value gaps are extremely simple concept, yeah? A fair value gap forms when we have a large move in the market, an influx of buys or an influx of sells in this instance here. We have a downtrend here, a very big push down. This is the 1 minute chart. If we go into the 5 minute chart, we have the same thing. Price is fractal, so these confirmations work on every single time frame. You can use them on the hourly, the 4 hour, the 1 hour, the 5 minute, the 1 minute, it does not matter. Of course, higher time frames are more powerful and have more confluence than smaller time frames. You have to pay attention to the market structure that you're using. But say we'll use this 5 minute structure here because it's a beautiful example. We've got a push down, 5, 10, 15, 20, 30 minutes of bear. Okay, we've got a push down here. Now, within this push down, we have 1, 2, 3 fair value gaps. It doesn't matter how big or small they are, you should pay attention to all of them. So, how we spot a fair value gap in the market is, we have this push down here. This is where our fair value gaps lie. Now what happens here is price moves so fast that not everybody gets into their sell position, so it leaves a gap in the market. So how do we identify them? Boom, you've got 3 candles. A fair value gap is a 3 candlestick pattern. We have 1, 2, 3 candles. The gap is drawn from the first wick and the third wick. You can see here, in between the first and the third wick, we have a gap in the market. This is your fair value gap right here. This is where you can take your positions from. So a fair value gap is a retracement pattern. We are looking for price to enter the gap, fill orders, and then retrace lower. If price breaks this fair value gap, we then call it an inverse fair value gap, and you can use it on the opposite direction. Price will come up, break with a full body closure, and then come back down to retest and then move off, creating higher highs. Now, let's go through that again. We've got a 3 candlestick pattern, 1, 2, 3. The first wick and the third wick do not meet. They don't meet, so it causes a gap in the market. Now, we've got our box here. This is how I draw them out on the chart. We use our box tool, we type fucking, not some emojis and shit. Oh, for fuck's sake. What the fuck is going on there? Alright. Fuck knows what happened there. Type in FVG. Now we've got our fair value gap marked up. It's as simple as that. That's it. A fair value gap is a 3 candlestick pattern. The first wick and the third wick do not meet. The gap is this area here. You can take your positions off of here after you see price rejecting, stop loss above the fair value gap, 1 to 2, and you can take your position off of here. Of course, you can't just enter trades off of fair value gaps. This is just one part of the system, but this is an entry confirmation, a fair value gap. We have 2 fair value gaps here. We have a third one too. This one here. The wick of the first and the third don't meet. So you've got this one, this is your gap here. Boom, so there's 3 fair value gaps on this market structure. This one is now invalid because it's been chopped through. We've had it chopping through it, so I would just remove that. Fuck it, no point. We don't need it. There's other things that we can go off of here. Now, once price breaks market structure, I ignore all fair value gaps above. Just to make that clear. So that's just on this said time frame. Now, if we go on the 15 minute, that doesn't mean that there's not going to be fair value gaps that are respecting on that market structure. Price is fractal, so yes. But quite simply, that is how you spot fair value gaps in the market. 3 candlestick pattern, the wick of the first, the wick of the third do not meet, causing a fair value gap or an imbalance in the market. it said that price but price will potentially come up, fill the fair value gap, and then retrace or continue the market structure. If price breaks a fair value gap, like we have here, so let me just get rid of this, let me just come to here. So on this pump here, we have fair value gaps in the market. We've got 1, and we've got 2. Sweet. Now, watch what happens. Price breaks and closes below, not wick. Not wicks. If wicks below and then still closes within this fair value gap, then it's of FVG. But price breaks and closes. We have a full candle closure or a full body closure underneath this FVG. So we can now call this an inverse fair value gap, which is marked as an IFVG. Same with this fair value gap here. It has been inversed, so we call it an IFVG. Easy stuff, simple stuff. And before I leave off on this video, I will let you know that my mentorship applications open again on Friday. So there's very limited spaces. Spaces will go fast, they always do. If you are interested in working with me one-to-one privately and learning exactly how I day trade the markets and run my life as a trader, get in touch and fill out the application form below. I look forward to hearing back from you boys. Peace.